Foord has often described itself as a safety-first fund manager. But what does that mean in the context of investment returns and the stage of market cycle? I'm JC Xue, Portfolio Manager at Foord Asset Management. The father of value investing, Benjamin Graham, said that an investment operation was one which promises safety of principal and an adequate return. This seems to summarize what most of us want from our retirement portfolios. Foord's safety-first approach embraces this definition of investing. We eschew speculative activity which carries unnecessary risk. To us, risk means loss of investment capital. The biggest destroyer of capital over long periods is inflation, and Graham's adequate return must therefore exceed the long-term inflation rate for investors to achieve their investment goals. So, we must preserve investment capital and compound inflation-beating returns over long periods. Long experience has shown us that avoiding big losses helps dramatically with this outcome, since compounding negative returns is as dangerous as compounding positive returns is helpful. The risk of investment loss is counter-cyclical. Risk increase as the business cycle matures and investment market rally to new highs. Conversely, risk of loss abates after markets draw down in anticipation of a slowing business cycle or an external economic shock such as the COVID-19 pandemic. After the March 2020 reset, global markets have been on the tear. Massive global monetary and fiscal interventions fueled an everything rally, pushing the global markets to all-time highs. The S&P 500 index has doubled since its March 2020 lows. Global markets in aggregate have gained 92% in US dollar terms. Concurrently, labor shortages and supply constraints have raised the specter of uncontrolled inflation. Global bond markets have been the first to sell off on the prospect of hard choices central bankers will need to take. Coupled with worrisome global geopolitical risk, high valuations, and rising inflation poses threats to investment portfolios that warrant some caution. Ford's strategy has been to have a lower than average weight to the riskier areas of the market, which includes stratospheric US tech stocks and global bond markets. Many of these areas have pushed ever higher. As a result, our investment returns in the last 18 months have lagged less cautious peers. While global equity funds have lagged, Ford's well-diversified multi-asset funds have nevertheless delivered more than the yardstick of adequate return needed to beat compound long-term inflation-beating returns. We're happy with this outcome, knowing that prospective risk of loss are being managed while still growing investor capital. This safety-first strategy worked in the 1997 Asian financial crisis, the 2008 global financial crisis, and the 2020 COVID-19 pandemic. It should again deliver the goods if 2022 proves to be a watershed investment year should interest rate rise unexpectedly to counter the inflation threat.